You're staring at two numbers tonight. One's a credit card balance that keeps creeping up no matter how much you send it. The other's your retirement account, and it's smaller than you'd like to admit out loud. The question that's kept you up more than once is which one you actually deal with first. Do you attack the debt so it stops eating your paycheck? Or do you put money into retirement before another year slips by? The honest answer is that most people get this order wrong, not because they're careless, but because nobody ever laid out the actual math for them. That's what we're doing today. The real order of operations, not a guess and not a guilt trip. Quick disclaimer: this is education, not financial advice. So for your specific numbers, talk to a licensed financial advisor. And if this is useful, hit like, drop your situation in the comments, and subscribe so you don't miss the rest of this catch-up plan. Let's get into it. So where does the order actually start? Not with your debt at all. If your job offers a 401k, that's the retirement account many employers set up, where money comes straight out of your paycheck before you even see it. Check whether your employer matches what you put in. A match means your employer adds money to your account when you contribute, sometimes matching a portion of what you save, up to a certain point. As a simple example, if you put in $1 and your employer adds another dollar on top, you just turn that dollar into $2 instantly before it's grown a single cent on its own. No credit card interest rate, no loan payoff, nothing beats an instant, guaranteed addition to your own money like that. That's why the very first move, before you decide anything about debt, is to find out if you're leaving that match on the table. One thing worth checking while you're in that portal is whether your plan has something called a vesting schedule, meaning you only fully own the employer's matching money after you've stayed with the company a certain number of years. Leave too soon, and you might walk away with less of that match than you thought. It's still generally worth capturing, but it helps to know what's already yours today versus what depends on sticking around. You can check all of this tonight. Log into your benefits portal or call your company's HR department and ask two questions. Does my plan offer a match? And am I contributing enough to get the full amount? If the answer is no, that's usually worth fixing before you send one more extra dollar to a credit card, because that unmatched money is gone for good once the year closes out. Now, there's a real exception here, worth naming plainly. If your debt is the kind that's genuinely threatening your ability to keep the lights on, a collections call every week, a payment you can't actually cover, stabilizing that comes first, match or no match. Nobody's account balance is worth a stress that's actively damaging your life. But for most people reading their statement and feeling behind, not overwhelmed, the match is the starting line. It costs you nothing extra beyond what you were already planning to save, and it's the one part of this whole equation that isn't a gamble or a guess. Go check your own plan before you read another word about debt strategy, because everything after this assumes you've already captured that match. Now let's talk about the debt that's actually working against you the hardest, because not all debt behaves the same way, and lumping it all together is where a lot of people get this order wrong. Credit cards, and some personal loans, tend to carry some of the steepest interest rates of any common debt out there, and interest in plain terms is the cost of borrowing money, charged as a percentage of what you owe. What makes it dangerous is that the interest compounds, meaning you're charged interest not just on what you originally borrowed, but on the interest that's already piled up from last month. Say, just as a simple hypothetical, you're carrying a balance and only paying the minimum every month. The interest can grow faster than your payment shrinks the balance, so you're running in place or sliding backward, while the number never seems to move. That's fundamentally different from the debt versus saving math you'll hear about with lower rate debt, because you're not weighing an uncertain investment return against a fixed cost. You're weighing a guaranteed ongoing cost against money that would otherwise be earning far less than that cost is draining. Put simply, paying off high-interest debt is one of the few moves in personal finance that comes close to a guaranteed return, because every dollar you send toward it is a dollar that stops generating that painful charge. That's why, once your employer match is captured, high-interest debt usually jumps ahead of extra retirement saving. And that's not because retirement matters less. It's because the math tends to favor stopping the bleeding first. Your move here is simple. Pull up every credit card and personal loan statement you have and write down the actual interest rate for each one, not the payment, the rate. Line them up from highest to lowest. That list becomes the map for where your extra dollars go first, once the match is locked in. And a quick word of caution, because people who feel behind are exactly who these offers target. If you ever see something promising to erase your debt fast, or guarantee a return that sounds too good, treat it as a red flag, not a shortcut. Real debt payoff is unglamorous, and it's math, not magic. Now, lower interest debt? Think mortgages, many auto loans, some student loans, plays by different rules, and this is genuinely where it depends on your situation. So let's walk through what it depends on, instead of pretending there's one right answer. The math works differently, because the rate you're paying on that kind of debt is usually much lower than what high-interest debt charges, which means the guaranteed benefit from paying it off early is smaller too. Meanwhile, money you put into a retirement account, whether that's your 401k or an IRA, an individual retirement account you open on your own outside of work, has decades, potentially, to grow. That money doesn't just sit there. It grows on top of its own growth over time, which is the idea behind compound growth. And over a long enough stretch, that effect adds up to meaningfully more than what you put in, though nobody can promise you exactly how much, because markets move and nothing is guaranteed. So you end up weighing a smaller certain benefit, paying off a low-rate loan a little faster, against a larger, uncertain one, money that has time to grow but isn't locked in. That decision comes down to a handful of things: your timeline to retirement, how much the payment itself is squeezing your monthly budget, whether the loan has any tax treatment that changes its real cost, and honestly, how you sleep at night with debt outstanding, because peace of mind is a real factor, even if it doesn't show up in a spreadsheet. Some people would rather carry a low-rate mortgage for years while their retirement account grows. Others can't stand owing anyone anything and pay it off early, even if the math says otherwise, and neither one of those people is wrong. What I won't do is tell you which one you are, because I don't know your rate, your timeline, or your temperament, and a licensed financial advisor looking at your actual numbers can help you weigh it properly. What you can do yourself right now is pull out your loan documents and find the actual rate you're paying. Most loan servicers will also show you an amortization schedule if you ask for it, or you can find free calculators through your servicer or a nonprofit financial education site, and plugging in an extra payment amount will show you exactly how many months and how much interest that payment would save you. Actual numbers for your actual loan, not a shot in the dark. Let's look at the situation a lot of you are actually in, which is carrying real debt and having little or nothing saved, and feeling like you don't even know where to start. The order that tends to make sense for that exact spot looks like this, and notice it isn't all or nothing at any step. First, keep every minimum payment current on everything you owe. Missing payments brings fees and damage that make everything else harder, so that part isn't optional. Second, if there's an employer match available, get enough into your 401k to capture the full match, even if it feels small, because that's money you can't get back once the year passes. Third, turn your attention to the highest interest debt on that list you made earlier, and put whatever extra you can find toward it while paying minimums on the rest. Some people prefer knocking out the smallest balance first, for the motivation of seeing a debt disappear completely, even if it's not the highest rate, sometimes called the snowball approach. Others prioritize the highest rate first to minimize what they pay overall, sometimes called the avalanche approach. Both work, and which one keeps you actually sticking with the plan matters more than which one is mathematically cleaner, because a plan you abandon in 3 months helps nobody. Fourth, once the high-interest debt is cleared, that same payment amount can shift toward building your retirement contributions further. And this is also where catch-up contributions become relevant, if you're at an age where they apply. The same idea applies to an IRA if you have one, and both the 401k and IRA limits, including the catch-up amounts, change from time to time. So the IRS website is where you'll find this year's actual numbers, not any video, including this one. Fifth, lower interest debt like a mortgage gets whatever's left on the schedule that fits your comfort and your timeline. None of these steps require you to have extra income you don't have. They require you to know your own numbers and follow them in order instead of throwing money at whichever bill feels loudest that week. And if you're sitting there thinking none of this applies because there isn't $50 extra a month, let's address that too. Because this plan isn't only for people with room to spare. If $50 is genuinely what you have, split it with intention instead of leaving it undecided. If there's a match on the table and you're not capturing it, even a small increase in your own contribution usually outperforms almost anything else you could do with that same $50. Because again, it's not growth. It's an instant addition to what you put in. If the match is already captured, put that $50 toward the highest rate debt on your list. Because on a smaller balance, consistent extra payments still shrink both what you owe and the interest charged on it faster than minimum payments alone. It won't feel dramatic month to month, and that's fine. The point isn't drama, it's direction. A small amount moving in the right order beats a larger amount moving in the wrong one, and it beats doing nothing while you wait to have more, because that wait has no guaranteed end date. If your income genuinely doesn't stretch to cover minimum payments at all, that's a different, more urgent conversation, and a nonprofit credit counseling service or a financial advisor can help you look at options like restructuring payments before things spiral further. That's not a sign of failure. It's a sign you're taking it seriously enough to get real help. One more thing worth pointing out, because this channel is for people at very different points along the same stretch. If you're closer to 60 than 50, your timeline changes the calculation, though not necessarily the order itself. With less time before you're likely to draw on that money, the uncertain, decades-long growth argument for prioritizing retirement contributions over debt payoff carries a little less weight than it would for someone with 25 years still ahead of them, simply because there's less time for that growth to happen and less time to recover from a rough stretch in the markets. That doesn't turn debt payoff and retirement saving into an either-or. It just means the guaranteed, immediate benefit of clearing high-interest debt tends to look even more attractive the closer you get to actually needing your savings to support you. It's also a good moment to start thinking honestly about when you might claim Social Security and what your accounts realistically need to cover between now and then, though that's a big enough topic to earn its own conversation. For now, the practical move is the same one from earlier. Know your actual numbers, both the debt and the balance, because the closer you are to needing this money, the more expensive a guess becomes. So let's put the whole thing back together. It's never really debt or retirement. It's a sequence, and getting the sequence right matters more than getting either piece perfect. Capture any employer match first, because that's the closest thing to free money you'll find. Point your extra dollars at your highest interest debt next, because that's the closest thing to a guaranteed return you'll find. Let lower interest debt and additional retirement savings share whatever's left, based on your own timeline and your own comfort, and don't be afraid to get a professional's eyes on the parts that genuinely depend on your situation. This week, do 3 things. Pull up your benefits portal or call HR to confirm your match. Write down every debt you carry with its actual interest rate, and check your 401k or IRA balance so you know exactly where you're starting from. Not where you wish you were, where you actually are. It doesn't matter if you're starting this at 45, 50, or further along than that. The comeback gets built step by step, in the right order, starting today. Next time, we'll dig deeper into catch-up contributions themselves, what they're for, and how they fit into everything we just covered. Until then, take care of yourself, and take that first step this week. Your comeback starts now.